Today we are going to decode one investment product that is becoming popular among income investors. 9.65 percentage Muthoot MC Cred NCD maturing on 18 September 2028. 9.65 percentage is the coupon. Annual yield to maturity of 10.95 percentage. It is secured and it is listed. Rating ICRA A. Monthly interest payout. Minimum investment in multiples of rupees 5 lakhs. But what does all this actually mean? Is this investment safe? Who should invest? What are the risks involved? And if someone invests rupees 10 lakhs today, how much money can they really earn? Let's break it down in the simplest possible way. What exactly is this investment? This is a corporate bond slash NCD. NCD means non-convertible debentures. NCD is basically a company borrowing money from investors. Instead of taking loan from banks, companies also raise money directly from the public. In this case, Muthoot Finance or its MC Cred Red platform is borrowing money and promising to pay fixed interest regularly. Return the principal amount on maturity. This bond matures on 18 September 2028. So this is approximately a medium term fixed income investment. Let's understand the important terms. Coupon rate 9.65 percentage. This is a fixed interest. If you invest rupees 10 lakhs, annual interest on 10 lakhs at the rate of 9.65 will work out to 96,500. You will receive 96,500 rupees per year. Since interest is paid monthly, 8,042 rupees every month before tax. This is why many retirees and passive income investors like such bonds. Point number 2, yield to maturity YTM 10.95%. Now this is very much important. Coupon is 9.65 but YTM is 10.95. Why it is higher? Because this bond may currently be available at a discounted price in the market. Meaning you may buy the bond cheaper than its face value and still receive full maturity value later. This difference increases your effective return. What does secured means? Secured listed. Secured means the company has pledged certain assets against this borrowing. If the company faces financial trouble, secured bondholders get repayment priority over unsecured lenders. This is better than unsecured bonds. But remember, secured does not mean risk-free. Recovery can still take time in worst case situations. What does listed means? Listed means this non-convertible debenture can be traded on the stock exchange. So theoretically, you can sell it before maturity. But there is a catch. Liquidity may be low, meaning you may not always find buyers easily at your desired price. Credit rating. The bond carries ICRA A rating. ICRA A rating generally means adequate degree of safety, moderate credit risk, timely servicing expected under normal conditions. But it is not a top tier rating. Here is the hierarchy simplified. AAA means highest safety, AA is equal to very strong, A is equal to good but it carries a moderate risk. Triple B and below is equal to higher risk zone. So this investment is relatively safer than low rated junk bonds but riskier than government bonds or AAA bonds. Why is the return so high? This is the biggest lesson investors must understand. Higher return usually comes with higher risks. If bank fixed deposits are offering 7% and this bond offers almost 11% YTM, the market is pricing some level of risk. Possible risk includes credit risk, business slowdown, gold loan industry stress, liquidity risk, interest rate risk, Never chase returns blindly. Risks involved are credit risk. If the company faces financial difficulties, repayment can be delayed or stressed. Even A-rated bonds are not default proof. Liquidity risk. You may not be able to exit quickly before maturity, especially during market panics. Interest rate risk. If market interest rate rises, bond prices will fall. So if you sell before maturity, you may incur loss. Business risk. Muthoot Finance operates heavily in the gold loan sector. Risks include gold prices volatility, RBI regulations, economic slowdown, loan default, loan default pressure. Who should invest in this kind of bonds? This investment is suitable for investors who are looking for passive income, retired investors, people who are in high tax bracket investors looking for fixed income diversification, investors who are comfortable holding till this bond till maturity, investors who have already diversified portfolios. Who should avoid investing in these bonds? If you need emergency liquidity, you should not invest. If you cannot tolerate credit risk, you should not invest. If you want guaranteed sovereignty safety, you should not invest. If you are investing your entire savings in one instrument, you should not invest. If you don't understand bond market risk, you should not invest. Never put all your money in one corporate bond. Minimum investment. So, rupees 5 lakhs multiples, meaning minimum practical participation starts from 5 lakhs. And investments can increase in 5 lakhs, 10 lakhs, 15 lakhs, and so on and so forth. So, this product targets HNIs and serious fixed income investors. So, time horizon required is this is going to mature on 18 September 2028. So, investors should ideally be ready to stay invested for around 3 to 4 years depending on the purchase date. This is not ideal for short-term parking. So, most important investors lessons are never invest just because returns look attractive, someone forwarded a screenshot, social media influencers have hyped it. Before investing in bonds, always check credit rating, company financials, debt level, cash flows, past repayment history, liquidity risk, and your own risk tolerance. So, final verdict is, so who should invest in this one? The answer is it depends on investor's profile. For someone seeking higher fixed income, monthly people who are looking for monthly cash flows, people who are looking for diversification beyond fixed deposits, this may be an interesting option, but it should ideally form only a small part of a diversified portfolio. So do not treat corporate bonds like a guaranteed bank fixed deposits. Money grows not when you chase returns. Money grows when you understand risk before reward. Disclaimer is, this video is only for educational purpose and not an investment advice. Corporate bonds carry credit and liquidity risk. Please consult a SEBI registered financial advisor before investing. Thanks.